Yeah, I'm losing my
NOB
edge.
Spread, Pete. This is a fan favorite. This is
Absolutely.
like considered like a probably the most cultish of the spread trades, like a cool spread trade that everybody has wanted to have access to.
Right.
But until now, it's been really hard to trade it. I mean, you remember us trying to walk people through the 3x1 knob, or it would go down to 2x1, or stuff like that with the big treasury futures. Maybe you can speak a little bit to the complexity of that and the costliness of that old NOB spread, and then we'll get into the 2021 version of it right now.
Right. And we know, and Frank, I'm glad you mentioned the ratios, which are not even static, they're dynamic, which means depending on where yields are and where do I start? Where do I stop? There's a whole, let me make this, rather than going through all this rabbit hole of complexity in treasury futures. Now, I'm going to try to just make it straightforward. Treasury bonds notes are quoted in terms of the bond price in the world of institutional futures. And that brings with it this inverse relationship, all these complexities that I'm not even going to list because it's like nobody needs to know them. It's just they're complex. Why do they do that? Because it's an elegant solution for an institution. Depending on credit quality, depending on duration, depending on the yield versus the standard yield of the coupon, all those different variables are wrapped into price. And it's very easy. It's a great equalizer. For you and I, it's a great sense of consternation and complexity. We don't need that normalization, that convenience of that. It doesn't work for us in the way it does in an institution. We need something else. So let's take out all that complexity and just trade what we know is the two different yields at two different points in time. Now, the NOB spread, what's great with treasuries, every treasury spread, it gets a name. We always love that, a NOB spread. We don't have a gold silver spread. What would be a Gilver? We don't trade a lot of Gilvers. And this was actually after I started trading treasuries, which is probably 6 or 7 years into my career, where I started in the FX world. The NOB spread was the first one I traded. I didn't even know about 2s versus 10s or fight spreads or any of those things. NOB was what everybody traded. But as you mentioned, a ratioed spread that 3-to-1 would cost you, even back 20 years ago, was still a $10,000 spread to trade. So a lot of complexity, a lot of challenges.
Yeah, and it's only gotten more expensive. Not to mention, he talked a little bit about the
$20,000 trade. Sure,
a little bit about the complexity of it, because with those prices, what's called dollar value of a basis point, or DV01, that was the dynamic piece. So you're constantly trying to hedge these two things that have a dynamic dollar value of a basis point. So it would go, I remember being there trading overnight, and it would be 3-to-1. And then some months it would be like, oh, it's closer to 2-to-1 now. And you have to go back and forth. Here in 2021, Pete, we don't have to worry about large sizes or crazy ratios, because we can look straight at the 10-year yield and the 30-year yield, the two component pieces of the NOB spread. And right now you can see that they're competing amid just a rally in the longer end of the yield curve here. It's been a big rally, especially in the 10-year. And when you have this, yes, you can go in and you can say, all right, well, I want to be long yields or short yields, whatever kind of broad bias there obviously being long yields has paid in the early part of 2021 here. But what's been interesting and what we really love about spread trading and pairs trading is you got a totally different look when you compare the two things to each other. Those two things that are rallying, when they're compared to each other, Pete, you've got a lot of back and forth here. Right. And a lot of just different opportunity. Like, this is the kind of scenario, Pete, where I wouldn't mind being long yields with either maybe I'm long an S10Y or I'm long an S30Y. And then you go in and you can still feel comfortable about, like, I can buy or sell this spread and I have diversified opportunity in there, right? Yeah. Like, look at these two charts. It's the same time frame, the same two products, just a totally different trade.
Absolutely. And when you equalize these different durations, so what I mean by that is that there's just a difference in the yield price, and that difference moving from 8 to 8.2 is whether you move there in from 2% to 2.1%, whether you move there in a 10-year or a 30-year, it's the same dollar amount. So the difference, very simple to figure out in terms of the difference in terms of the dollar amounts. Because if you go back to the other chart, Frankie, you think, okay, these are moving exactly alike. Then you look at the left rail and the right rail, and you realize, yes, they're highly correlated, but a very different divergence in terms of the prices of where we started, which was around 70 basis points back in December of last year to almost, where are we? Well, we're not that different, 80 basis points now. But traditionally, I would have expected 70 basis points. I would have expected, well, we'll talk about this in a little bit, but
Sure.
we traditionally expect a different type of movement. We expect a bullish NOB spread in terms of when the yield curve, when yields move up. But you're right. And I guess I'm getting off the point is two distinctly different trade. One, an opinion on rates, one, an opinion on relative value. So you've got the same set of products and you're getting two distinctly diversified trading, trading outcomes and trading strategies is really important. You know, we talk about diversification. So I got a metals trade on, a dollar trade on, a rates trade, and an equity trade. Is that diversification? Sure. It's better than having them all in the world of equities. But we want to then diversify through strategy within an asset class. And that's what we're starting to do.
No, that's a great point. And yeah, I think about it the same way where it's like asset class to asset class, that's great diversification. But even within the asset class, you know, we speak with such active traders that they have their outright bias. Am I long or short in this asset class? They've got options trades on it. And they also should, like we're talking about today, have spread or pairs trades on it. And each of those strategies within an asset class diversified in its own right. But yes, this is a lot simpler here with the S30Y and S10Y, a one-to-one trade that right now the initial margin for that is going to cost you just around $500. Crazy when you think about trying to do that with ZN and ZB futures, going to cost you well over $10,000. But I wanted to now swing the conversation into what I think is the best opportunity for this trade, which is short-term, like what you can see here. There's no sustained long-term action in this NOB spread since these, and it's funny because there's a 2-year, a 10-year, and a 30-year that we focus on. And you would think, okay, 2, 10, those are the closest to there. You would think that those kind of battle each other really closely. But what's funny is that the 10 and the 30, which has much more duration in the difference there, actually those two tend to be way closer, which to me signals better short-term opportunity because you're not seeing something here that has a long-term trend. Oh, I want to be long this spread for the next several weeks or months. And with that, Pete, I wanted to break into a little bit of a scalping talk here and then give people some expectations for trading this NOB spread because we look at the 10-year, Pete, on a daily basis, moving about 40 cents or 4 basis points. And you and I are constantly looking for if this S10Y gets up, if it's up 50 cents or 60 cents or 70 cents, we're looking to maybe get on the other side of that. Same with the downside. If it's down, you know, it almost got there. It was down almost 40 cents today and then it bounced back. If it's down 50 or 60 cents, we're looking to get on the other side of that for a bounce back. Very similar with the 30-year product here, the two durations moving about the same amount. And when you look at this spread, Pete, you know, when might this NOB spread be intriguing to you? It's about 20 cents worth of difference. So when I'm looking for potential trades in the NOB spread, Pete, these short-term scalps, which I think are the best opportunity for this particular spread that a lot of people in interest rates look at, it's when S30Y is maybe down 60 cents and S10Y is only down 30 or 40 cents. That's more than a 20-cent difference. And then I look at maybe a convergence there. Same with different directions, same with different leaders and laggers, a lot of different permutations where you can get this 20-cent difference. And once we get outside of that 20-cent difference, a lot of opportunity for trading the NOB spread.